Welcome to everybody once again. It's the 21st day of May. It is Wednesday, and I hope all are well. I just want to make a little video today about the US Treasury market. Now, you might say to yourself, what has that to do with me? Well, it's got plenty to do with absolutely everybody because the whole financial system globally pivots around the rate of interest in the United States Treasury bonds, namely the 10-year bond. Now, economics is a very simple thing, but for some reason, very few people seem to understand economics at all. Don't ask me why, because it should be basic. You will see people, for example, saying the economy was fantastic under Joe Biden. Well, it wasn't. They will say it was fantastic under Donald Trump. Well, it wasn't. It's fantastic under none of them because the United States economy is run similar to a fellow on a credit card. Every year they spend more than they take in, and the excess is simply put on a credit card borrowed from the market, basically borrowed from investors, which can consist of anything from mutual funds to investment funds to retirement funds, you name it. They will purchase US Treasury bonds, bills, and notes. And to the people that buy the bonds, they are assets to the United States government, which is the people. They are not assets at all. They are money owed. Okay, they're liabilities. So when you say a Treasury bond, what you really mean is an IOU written by the American government to a person who is foolish enough to lend the government money. And after 10 years, they'll be paid back the money, the principal, and a rate of interest for their risk. Okay? The risk has changed. Last Friday, after the financial markets closed for the week, a credit rating agency called Moodys. It's the big one. There's others, but this is the big one. Anyway, they lowered the credit rating from what's known as AAA to AA1 or AA1. Basically, they concluded that the United States wasn't as creditworthy as it was the day before, whatever. It's no different than you having a credit card. If your credit score is very weak, the amount of interest you will be charged is proportionally higher than if it wasn't weak. So that would see the interest rates on the debt load of the United States rising. Now, in the financial markets, frequently it happens that there's a little bit of a time delay. So Monday, it was, markets were down a little. Tuesday, it was down a bit or whatever. Today, the financial market seems to have digested what this means, and what it means is not very good. So it was down 800 points or whatever. The interest rates are rising. That means, inversely, the value of the bonds, which are just IOUs, are falling. It has an inverse relationship, the interest rates and the value of the bond. People think that the Federal Reserve will set the interest rates. That actually is not true at all. The Federal Reserve's system sets zero rates whatsoever. It tries to influence just one particular interest rate. It is referred to as the federal funds rate or the Fed funds rate. What that is it is the interest rates charged by banks in the banking system for overnight deposits. And how you change interest rates in the market is, if you wish to bring the interest rates down, you need to go into the market and purchase treasuries, driving up the price of treasuries and lowering the corresponding interest rates. That's a very simple explanation, but it is very simple. So the federal funds will set a rate of 0.25% where they would like that rate to be within. Say it is from 1% to 1.25%. So if the rate is rising close to 1.25%, they will enter the market and purchase Fed funds. Okay? And they will put liquidity into the market and it'll bring down the interest rates. So that will set a very short-term interest rate. It'll set a range, but it won't set the rate. But the market will keep within that range because the federal funds can be controlled by the Federal Reserve by either purchasing treasuries or doing the opposite, which is selling treasuries. When they sell the treasuries, somebody purchases those treasuries with actual money. That money will be taken from the system and it'll drain the money supply. It takes a little bit of getting used to follow what the interest rates do. Anyway, the bottom line is the United States is now recognized as not being as creditworthy as it was, and the interest rates are rising. Rising interest rates is a cost to the value of money. The United States government does not own the Federal Reserve. The United States government cannot just print money. I hear people saying, oh, they can print money. Well, they cannot print the money. The only people that can create the money are the Federal Reserve, which is a different entity altogether from the US government. So if the US government, the Treasury Department, needs money, they must issue bonds, which is to write IOUs, and will sell them to investors, and they will buy the bonds. The government will get the money, they will spend the money, and the Ponzi system continues on and on and on and on. So when Donald Trump left office on January the 20th, it's always January the 20th, of course, 2021, the United States government owed a total of approximately $27 trillion. That's a lot of money. In comes Biden, and he, in the course of 4 years, will spend $10 trillion approximately more than the government brought in. So when he was leaving office, the debt is now $37 trillion. So the economy was not good under Biden, of course. It wasn't good under Trump either, but it was catastrophically worse under Biden. Now, $37 trillion is a lot of money. When the interest rates are at 1%, the interest paid back on that debt is approximately $400 billion a year. It's a lot of cash. However, we're no longer at 1%. The interest rates have gone up now to about 5% in round figures. If it's 5%, the interest paid every year is no longer 400 billion. It is 1,800 billion in a budget of about 6,000 billion. The bottom line is we are now in a debt crisis. The interest is so much it cannot be paid each year because the interest rates has risen. That is why these tariffs must be brought in. They are brought in to collect a tax on the American people because the product is made overseas. The United States Constitution requires that the only form of taxation actually at a federal level would be tariffs on imports. Those were simpler times when you didn't have a government that was spending $6 trillion. But that's what the Constitution demanded because that is the only thing that makes any little bit of sense whatsoever. So, Doge was brought in, hoping to collect the necessary funds to balance the budget, which is practically impossible, of course, because it's now so high with the deficit that it's impossible to balance. It's too late to balance the budget. The last time to balance the budget was about 1992 when we had a fellow called Ross Perot. He was running to balance the budget and they didn't want to deal with that. And now it's 30 years later and the problem is gigantic and it's actually gone beyond possible to balance the budget. So we are approaching a debt crisis. What that means for Ireland is it's not good. We are going to go into a massive recession. Those industries over there in Ireland, they're going to see some serious repercussions. And the Ponzi scheme is now over. What we'll see in the next few weeks will be mind-boggling, and you better batten down the hatches because it's going to make a lot of difference to you. On a personal level, well, this video is not to give advice. It's actually illegal to give financial advice, and it's a waste of time anyway because people don't listen to advice. But yesterday I was talking about two proverbs, and I'll give you another old saying now. I'll tell you what to do as well. If you're on a sinking ship, what do you do? It's very simple. You get off the ship. So you better get off this ship and protect yourself. And as my friend Sean Tully, he will know exactly how to protect yourself. I will leave it to the rest of you to figure it out. But that's just a little bit of a heads up. That not very much reported news from last Friday evening is the most important news that I've seen in the last 6 months. And it signals that now the rug is going to be pulled out of the world economy and indeed out of the Irish economy as well. And anybody that doesn't know what a rug pull is, well, they're lucky because that might suggest they weren't foolish enough to buy any cryptocurrencies. A rug pull is when the money has been taken away, when the smart guys have made their loot, they will collapse the system and the suckers will be left holding the bag. Now, that's just a little bit of a heads up. I don't spend too much time talking about economics because it's a very, very small field with very few people interested in it. But I will guarantee you there'll be more people interested in it in a month or two than what we've seen up to this. So thank you for watching.